Hey everyone, welcome back to our channel. Today, we're diving into a topic that affects us all, the value of cash. We're often told that saving in a bank is the safest way to build wealth. But is it really? With inflation rising and bank interest rates lagging behind, your cash might actually be losing value. In this video, I'll walk you through 6 assets that are safer and better for building wealth than keeping cash in the bank. Let's get started. First up, we have precious metals. You know, the classics, gold, silver, platinum. These metals have been used as stores of value for centuries and for good reason. They're durable, they're divisible, and they're universally recognized. Take gold, for example. For thousands of years, people have viewed gold as a safe haven asset, especially during times of economic uncertainty. And guess what? It's still true today. Now, I'm not saying you should convert your entire life savings into gold bars, but having a small portion of your portfolio in precious metals can be a smart move. When inflation rears its ugly head, the value of your dollars goes down, but the value of precious metals tends to go up. Think about it. An ounce of gold in the 1950s would have cost you around $400. Today, that same ounce could fetch you over $2,000. That's where gold ETFs or exchange-traded funds come in. These are like mutual funds that invest in gold, making it easy to add some gold exposure to your portfolio. So if you're looking for a way to protect your wealth from inflation and diversify your portfolio, precious metals are definitely worth considering. Next up, let's talk about industrial commodities. We're talking about raw materials like cobalt, nickel, copper, and silver, the building blocks of our modern world. These metals are essential for manufacturing everything from smartphones and laptops to electric vehicle batteries and solar panels. As the world transitions to a more technology-driven and sustainable future, the demand for these metals is only going to increase. Let's take cobalt as an example. This metal is crucial for the lithium-ion batteries that power our phones, laptops, and electric vehicles. Over the past decade, the demand for cobalt has skyrocketed, and so has its price. You can invest directly in mining companies that extract these metals or in commodity-focused ETFs that track the price of these commodities. Industrial commodities offer a unique opportunity to invest in the future of manufacturing and potentially capitalize on the growing demand for these essential materials. The bottom line is, industrial commodities are a smart way to diversify your portfolio. Now let's talk about safe haven currencies. These are currencies that tend to hold their value or even appreciate during times of economic or political turmoil. Think of them as the financial equivalent of a warm blanket on a cold night. They provide comfort and stability when things get rough. So, what makes a currency a safe haven? A stable political system, a strong economy, and a sound monetary policy. When investors get nervous about the global economy, they often flock to these safe haven currencies as a way to protect their wealth. Historically, the Swiss franc has been considered the ultimate safe haven currency. Switzerland has a long history of political neutrality, a stable economy, and a rock-solid banking system. Other currencies, like the Japanese yen, the Norwegian krone, and even the US dollar, can also act as safe havens during times of global uncertainty. One way to incorporate safe haven currencies into your investment strategy is through currency ETFs. These ETFs track the performance of a particular currency, allowing you to gain exposure without having to open a foreign bank account. Safe haven currencies can provide an additional layer of diversification and potential protection for your portfolio during times of economic or political uncertainty. Let's face it, we all want our investments to be safe and secure. And when it comes to safety, it's hard to beat government-backed securities. These are debt securities issued by governments to finance their operations. In the US, we're talking about treasury bills, treasury notes, and treasury bonds, often referred to as T-bills, T-notes, and T-bonds. Now you might be thinking, Graham, government bonds sound kind of boring. And you know what? You're not entirely wrong. They're not exactly the most exciting investment out there. But that's kind of the point. Government bonds are designed to be a relatively low-risk investment that provides a steady stream of income. When you buy a government bond, you're essentially lending money to the government. In exchange for that loan, the government promises to pay you back the principal amount of the bond plus interest. And because these bonds are backed by the full faith and credit of the US government, they're considered to be extremely safe. The interest rates on government bonds aren't going to make you rich overnight, but they're generally higher than what you'd get from a traditional savings account. Buying U.S. Treasury bonds is incredibly easy. You can buy them directly from the U.S. Treasury Department through their website, Treasury Direct. So if you're looking for a safe and reliable way to invest your money and earn a decent return, government-backed securities are definitely worth considering. Now let's talk about stocks. But not just any stocks. We're talking about value stocks. In the stock market, you've got two main camps: growth stocks and value stocks. Growth stocks are like the flashy, popular kids in school. Everyone knows their names, and they're always in the spotlight. These are companies that are growing rapidly and are expected to continue growing at an above-average pace. Think tech companies, innovative startups, that sort of thing. Value stocks, on the other hand, are like the quiet, under-the-radar kids who are often overlooked. These are companies that are well-established, have a solid track record of profitability, but for whatever reason, the market isn't giving them much love. They might be in industries that aren't exactly sexy, think utilities, consumer staples, industrials. But here's the thing about value stocks. They can be absolute diamonds in the rough. Because they're often overlooked, they tend to trade at a lower price relative to their earnings and assets. This means you can potentially buy into these companies at a discount and reap the rewards as the market eventually recognizes their true value. Dividend-focused mutual funds invest in a basket of value stocks that pay high dividends, those regular cash payments that companies make to their shareholders. Value stocks and dividend-focused mutual funds can provide a great way to generate passive income and potentially outperform the market over the long term. Last but not least, let's talk about real estate and land. Real estate has been a cornerstone of wealth building for centuries, and for good reason. They're not making any more land, right? So, as the population grows and demand for housing and commercial space increases, the value of real estate tends to rise. Now, I know what you're thinking. Graham, real estate is expensive. I don't have hundreds of thousands of dollars lying around to buy a property. Coming up with a down payment for a property can be a significant hurdle, especially for first-time buyers. But you don't necessarily need to buy a whole property to invest in real estate. You can start small with REITs, or real estate investment trusts. These are companies that own and operate income-producing real estate properties. When you invest in a REIT, you're essentially buying a small piece of a diversified portfolio of real estate assets. REITs are a great way to add real estate exposure to your portfolio without the hassle of being a landlord. Whether it's raw land, farmland, or even just a vacant lot in a growing neighborhood, owning land can be a powerful way to build long-term wealth. So there you have it. 6 assets that are better and safer for long-term wealth than simply leaving cash in the bank. Remember, diversifying your investments helps protect your wealth from inflation and market shifts. Which asset would you consider investing in? Let us know in the comments below. And if you enjoyed this video, don't forget to like, subscribe, and hit the notification bell for more insights on building wealth.